Hi everyone, this is Bhavna and you're watching Good Returns. We all know that the performance of mutual fund is contingent upon market conditions and the volatility of the market decides how they would fare. But unfortunately, not everyone is aware of the nitty-gritty of the market, which makes it difficult for people to decide which category of mutual funds to invest in. If you also belong to that group, then this video will definitely help you a lot. For the next few minutes, we will be discussing something that has been termed savior for investors. We will be discussing about balanced advantage funds. So let's get started, but before that, do not forget to like, share and subscribe us. BAFs or Balanced Advantage Funds are hybrid funds which are also known by the name of Dynamic Asset Allocation Funds. Let's break it down further. It is referred as a hybrid because the allocation of assets happen between two classes, that is equity and debt. And it is called dynamic because it is managed depending on the prevailing stock market conditions that are dynamic in nature. But why exactly would we need BAFs? In simple terms, the answer is to avoid various types of investment risk such as trading volume, settlement risk, liquidity risk, default risk and potential principal loss, etc. Usually all these risks are there when we purchase any mutual fund units. Now let's understand how the BAFs actually work. Again, very simple, the act of making a balance between equity and debt is the basic premise of balanced advantage funds. So the fund manager simply shifts the assets allocation from equity to debt or vice versa based on market valuation. They shift to equity when the valuation is low and shift back to debt when the valuation is high. These hybrid funds are dynamic in nature and provide great flexibility. Risk and volatility are significantly lower in balanced advantage funds because of their minimal exposure to debt. These funds can also take advantage of dynamic market movements. Now let's look at who should ideally invest in BAFs. Firstly, investors who want capital appreciation and income over long investment periods. Secondly, those who are new to mutual funds and are not comfortable with high and unpredictable volatility. Thirdly, those who want to take a middle ground in the terms of risk. The fourth category is of those who have a minimum of over 3 years in the investment horizon. And the fifth category would be of those investors who want to make equity-like returns but want lower volatility in NAV. And the sixth group would be of those investors who are planning their long-term goals such as retirement. The percentage of equity and debt in BAFs completely depends on market conditions. Generally, the minimum percentage of equity is considered as 30%, but it can be raised up to 80 to 90% when the market conditions are conducive for it. Although these are generally considered low-risk funds, but as we all know, no mutual fund schemes that involve equity investments can be 100% safe. So, to handle the risk, make sure you also do research at your own level apart from our suggestions. Try to understand your need, financial goals and invest only after due diligence on your part. So that's all in this video. I hope you find this information very useful. See you in the next. Bye.